do have to remember that this has been a global phenomenon that's been going on, and the central banks, you remember the terms global coordinated central bank actions. So even when there were periods, you might ask to say, well, the Federal Reserve was not increasing the balance sheet from 2014 to 2018. Why was the market going up? Well, when you look at, this is from the Reserve Bank of New Zealand, looking at this period through 2020, the different lines will show the different central banks' balance sheets around the world. So you'll see from that 2016 to 2014 to 2018, this red line, the US Federal Reserve had stopped purchasing assets. You'll notice that the blue line, the European Central Bank, picked up the slack. And then the Bank of England in 2016 picked up and started printing. So you'll notice these ebbs and flows even from 2011 to early 2013, when the Fed had stopped their printing. The European Central Bank picked up, and then the European Central Bank dropped off its stimulus, and the Federal Reserve picked it up. So that all brought us to what happened in March of 2020, and all the central banks around the world just went bonkers and started printing I think it was like something $8 to $10 trillion. The Federal Reserve pumped $3 trillion themselves, along with $4 trillion of federal government fiscal spending. But so when you look at the S&P as a comparative to not just the Federal Reserve, but this one shows the three major banks, the US Fed, the European Central Bank, and the Bank of Japan, you'll see that there is much more of a tighter correlation when you aggregate the central bank actions around the world with the performance of the S&P. You're getting pretty much to a 99% correlation. Cause and effect, absolutely. And so markets, as they've continued to print money out of thin air and shove it in the markets and buy up assets, the S&P has just ballooned and taken off northward with that expansion of global central balance sheets around the world. But now when we look at, why has the S&P done so well? Well, when you look at the different indexes around the world, this is the China index. And you'll see in 2007, it had a big spike and then it collapsed, but it's literally gone nowhere since, a first initial recovery back in 2009. It's just been in this sideways malaise. And then you change that, you look at Europe, and it's a very similar pattern. It barely broke out to a new recent high on the back of these trillions of free money that's been pumped out, but still have not made it back to their 2007 highs. But then you make that comparison to the S&P. This was the S&P's peak in 2007. This is where we are today. Why is that? Well, all that free money goes where it's treated the best. And due to interest rate policies, the US has maintained a 0 to positive interest rate environment, whereas Europe has gone negative due to their massive amounts of bond buying, and Japan is there by policy decree in negative interest rate territory. So, basically the US has been the cleanest dirty shirt in the hamper. And that's why all the money flows around the world have been flowing into the US, not to mention the massive amounts. Corporate share buybacks have been the number one influence on markets ever since the 2009 bottoms. But moving on from all that, and so that will continue until it doesn't. Everything's fine until it's not. And that's how markets work. Believe it or not, markets are still a two-way street. But now looking at our different fund models, so since we started with the internal fund management at HK in 2017, our conservative fund, which is half US stocks, half US bonds, mainly US focused, from August 2017 up to today, the orange line, it is up 16.2%, whereas the equal weight, not the S&P, the S&P is market cap weighted and basically is just another reflection of a technology index. The equal weight US market index is 1,700 companies across the broad US markets, broadly diversified and equally weighted, which represents what your average investor's stock performance would be. That's what we want to compare ourselves to, is can we do better than 95% of all average investors out there, which is people who do it for themselves and your professional, quote unquote, financial advisors and financial planners that follow the Wall Street methodology of buy and hold diversified portfolios. The difference that we are looking to attain and achieve for our clients is preserving client wealth and protecting their capital. This was the late 2018 crash into Christmas, and this was March of last year. So head to head, the conservative fund is underperforming by 9%, but not bad when you look at the history of what markets have done over this period of time. Our moderate fund, which is a global opportunity fund, is up 10% over this same period of time. And once again, similar in mitigating risk and losses and preserving wealth. Now, if you really want to have an apples to apples comparison, our aggressive 100% US equity fund, we started this one a year later in August of 2018. And you'll see that it avoided those losses into Christmas of 2018, get the growth, protect from the dip, get the growth. You'll see this perpetual grind higher. We were completely avoided the crash in March of 2020, and then we got another kick higher. So start to finish, our US fund is up almost 19%, while the US markets are up 16.5% for about a 2% beat head to head. But once again, if we avoid the losses in the first place, we don't have to waste time making losses back. So moving on, our 100% international fund. So it's only up 6.5% over this similar period of time to the US fund. But as we showed in those previous index charts, that everything outside the US has just been this sideways grind of just up and down, sideways motion. It's the only index out there that's done anything is the S&P, and that's on the back of 5 big technology companies. And remember that the entire market structure is dependent on 5 technology companies in a zero interest rate environment. Do you think that will ever change? Well, you remember 2000 .com bubble, right, and how that burst. Anyway, moving on, our long short contrarian fund. So this one is specifically designed to make money when markets collapse. That's why it's a contrarian nature fund. You'll see in March of 2020, it did great. It was up 40% while the US markets were down 40 for an 80% beat head to head. But since then, it's been a bear of a time, no pun intended, for a bearish or contrarian fund fighting the full power and awesomeness of global central banks printing money out of thin air. And so it has really had a heck of a time dealing with all this. But buying stocks at all-time or recent lows is the same as shorting markets at all-time highs, right? You're simply looking for an inflection point or a change of direction. So when these markets do give up the ghost and barrel lower, then this long short contrarian fund will have its turn to shine in the sun again and take off higher. So this is accessible and available for diversification and opportunistic purposes for people who want to benefit from downward markets and think they know when that turn will begin. Moving on. As of January 1st, we started a managed S&P fund. So this is one ETF. It is a triple levered S&P ETF. And we do compare against the S&P 500 index because it is an S&P managed fund. Every other fund we have compares against that equal weight US market index and your average investor's performance. But you'll notice that when this fund is caught up to the S&P, it's done it in very rapid succession because of that triple leverage. Now, it's up 7% for the year, and we're fine with that. That's the S&P 500 average over the last 100 years, right? If you've been invested for that 100 years, that is. But with the markets in this massive bubble that they are, we are simply waiting for a larger corrective move in the S&P first before we get reinvested again at a relative low and look for the following counter-cycle upward trend. No reason to have a triple levered fund in the S&P to experience that down move and triple the losses. So this, we're just taking our time and being patient and waiting for the next opportunity to get in for an upward move and inflection in the S&P. Now, We have 4 specialty funds. As of June 1st, 2020, we started a precious metals fund. Now, looking at the long-term performance of the gold chart, you'll see that this was the run-up out of the 2007, 2008 crash up into 2011 when they started printing stimulus right around here and things took off. Then it had a deflationary wave that flowed through global markets, and gold bore the brunt of it as China reduced their credit impulse and things made a move towards more deflationary environment. But since then, coming in through 2019, you see this big run from about 110 up to 185. Now, we didn't start this fund until June of 2020. So we started right about here. So you'll see we caught the last little tail end of the move, and then we've been in this consolidation pattern. But I'm looking for this pattern to be a bull flag, and similar to some of these previous consolidation periods, for this to turn and run much higher as inflation kicks off and takes over the market narrative as we move forward. So hence, here's the performance chart for the Precious Metals Fund. You'll see we got that last little kick higher, and then it's just been trading this consolidation range. So even though it is down 20% from its inception point, remember that what if we'd started the fund back here in 2015? The performance would be astronomical. But just remember, as an investor, your returns are always indicative of your start point and your end point, not necessarily the overall market structure and what's going on or what's coming down the road. So we have this fund. We also started up a Bitcoin fund on June 1st of 2020, and it's currently up 174%. So we got that run up into the peak of March, and then tried to mitigate some of the downturn in Bitcoin, and then there were a couple of large gaps higher on this recent run in Bitcoin, which we missed out on. That's in such a volatile asset class, and especially something that trades 24 hours a day, 7 days a week, as compared to the public markets that we can only trade Monday to Friday during market hours. So there are performance gaps, but just remember, we are not buying Bitcoin to own the coin. We have this fund to gain access to the underlying performance of Bitcoin itself. So being up 174% compared to US markets at 55, this is just another diversification tool to give people a non-correlated asset class and some proportional exposure into some arenas that they may have interest in without actually going through crypto wallets and so on. So the Bitcoin fund's doing great. Now, the last 2 funds that we started in November 1st of 2020, the first one is cannabis. So cannabis, this fund, we started right around here. So as you'll see in the performance chart next, we saw a run up and a peak, but then it's just been, once again, a bear of a time trying to make money in a downward moving asset class. So this is now lower than where the fund started at, but you got to think about this as a longer term play. It took off after the elections, but with cannabis, it's only currently legal in cities and states. When the federal government legalizes it federally and across the nation, then, which I think they will at some point because they desperately need the tax revenues, and that's a big cash and tax revenue originator or creator for them. So when that time comes, you will see all the big alcohol, tobacco, and big pharmaceutical companies come in and buy up all of these mom and pop cannabis shops, and you'll see this cannabis index take off to the moon. So either, one of 2 catalysts probably is after the next crash, drop, whatever you want to call it in markets, after the Fed messes things up and breaks something in the markets again, then that will start their next round of massive stimulus, and we could see an upward move just from all the free liquidity, or more importantly, a change in public policy and legalization at a federal level. So that's what this is looking at, that longer term play. Here is the performance of the cannabis chart, which head to head, basically, it's flat. It's done nothing since inception. Here was the big spike, and then we've just been fighting a downward moving market. Look, we've been getting in, trying to look for good entry points to at least get some small moves higher. But the problem is, it just keeps rolling over each time we've gotten into it. So, like I said, that's a longer term play, and it's something that's available moving forward if anyone has a desire in that. And then finally, the commodities fund, which we also started November 1st, and it's up 33.5% since over that time frame. But we started, a lot of these funds as a diversifier option, but also because of, I'm expecting inflation to really hit hard and to take off here. And so commodities, the raw ingredients of any economy, those are your traditional inflation hedges, those and precious metals as well. But think about when the cost of raw goods goes up, what is that? Those are your commodities that are going up, and that is what inflation is, the price of those going up. Hence, having the commodities fund available as an opportunity to benefit from inflation was the impetus to get this fund started. So that rounds out our full suite of current fund options that are available for people to utilize for their own benefit. And obviously, we with each one of the funds, we are looking to try and lock in gains and also mitigate losses as much as possible to give a better long-term, full market cycle performance to the different asset classes and fund models. Now, looking at where the markets overall currently stand, you've got, this is the real S&P. So that is your inflation-adjusted S&P returns. And you'll see that this is a comparison of where the S&P was in relation to its long-term exponential growth trend. And you'll see the periods of over-exuberance in the early 1900s, the 1929 peak, you've heard of the 29 crash, right? Into the 50s, and then dot-com 2007, and where we are today at all-time distortive levels. But more importantly than that, what you have to think about is from these peaks, what do they really mean? So from the peak here, back in the early 1900s, through the trough, just to make your losses back, you're looking at about a 25-year period here. I know they're running it out 52 years, with the exception of the 29 top and then this little peak here in 35, but still 52 years of no returns for people who just bought and hold and sat there holding the same investments throughout that period. But reality, you've got a 25-year period, and then from 29 to 53, you're looking at about, 24 years in there. Then you got a move higher in the overall market, but then from the peak to the trough and back again, that's 26 years of no returns. And then running into the dot-com bubble, 2007 on an inflation-adjusted basis, never got anywhere near what the dot-com bubble was. So, really, the markets were flat from 2014 to 2016. So you could really call this 15 to 16 years of zero returns. But now you've had this mother of all bubbles blow out. Hence, when inflation bites, when the Fed has to do a 180-degree about face and turn, what sort of number of years or decades are investors going to be looking at where they are in the hole and have lost money on a total return basis? This is why we pound the desk about preserving client wealth, mitigating losses, and holding onto their capital. Sometimes return of your capital is much more important than return on your capital. So this is something very much people need to keep clear in their minds of where we stand today on a historical basis and what comes next. One final thought on all this. You remember just not that long ago, so the Fed presidents Kaplan and Rosengren were caught up in a scandal that led to mass outrage that they had been trading, basically insider trading, all the Fed policy moves and all the stimulus moves and buying stocks all the way up through all these periods. And then somehow someone heard a leak. A little birdie told them what was going on the inside. I'm a little bit more of a skeptic, and I think that they purposefully let the cat out of the bag to give themselves the excuse to do what? Well, we will sell all of our stocks due to ethics concerns. This was the headline on September 9. So now that the Fed presidents and the insider traders that have personally benefited from all this, now they're saying that, well, the public is demanding that we sell, so we're going to sell everything effectively. They can cash out at the top. And now the markets are free to crash and burn because the people that really matter already have all their money out of the market. So these are all things to keep in mind and understand the deeper, behind the scenes and below the surface of what's truly going on out there. Feel free to reach out to me with any questions or concerns. My cell phone number is here, and then also my email address to reach out. Our website is listed there as well, and the Fund Models tab on the website has all of those fund models that we just discussed, and those are updated on a weekly basis. So you will always have a real-time insight into how the different funds are performing. So take care, and we will talk to you again come next quarter if I don't hear from you sooner. All right, take care.